Hi everyone, welcome to The Market Interest, a show where we help people make smart decisions with their money and better understand the investment markets. My name is Brian Marois. On today's episode, we'll be discussing the semiconductor chip shortage. And for our financial wellness segment, we'll talk about the differences between growth stocks and value stocks. But first, let's start with our market update. The S&P 500 index is up 78% from the lows last year to March 31st of this year, a surprisingly fast rebound in a short period of time. And there is pent-up demand. With people getting vaccinated and getting their stimulus checks, this seems to be a perfect storm for recovery in our economy. There continues to be concerns about inflation, though, especially with so much stimulus being passed out. This is something analysts and myself will be watching in the near future. All right, it's time for our Market Makers segment, part of the show where we discuss what's making the markets move. There's a shortage in the semiconductor chip space, while the market is demanding more. Now, why should you care? Semiconductors are used in everything nowadays. Computers, cell phones, cars, video game consoles, you name it. When there's a shortage in the supply and an increase in consumer demand, prices begin to rise for the consumer. So why is there a shortage? During the pandemic, companies like NVIDIA, Qualcomm, Intel, AMD all had to shut down their production. They had to put it to a halt. At the same time, consumers were still buying their products like computers to work from home. And I know a lot of people were upgrading their Xboxes or PlayStation to play more Call of Duty. And now that people are returning to work, employers are investing in technology and replacing their old hardware with new computers. And let's not forget about the auto industry that's requiring all the new high-tech chips for their new fleets. What does all this mean for the sector? Well, chip stocks have soared to all-time highs over the past year. NVIDIA was up over 120% and AMD over 90% within this past year. With levels so high, it would be wise to invest cautiously. If you're wondering if you should be investing in the chip sector, click the link in the description below to schedule a free consultation, and I'll help you determine if it's an appropriate investment in your portfolio. All right, it's time for our financial wellness segment, part of the show where I give you education and tips about how to improve your financial wellness. What is the difference between growth and value stocks, and which one should you be investing in? Well, there are similar characteristics between the two, which is why some experts have said growth and value are opposite sides of the same coin. But there are fundamental differences that can be observed. Growth stocks tend to be the sexier investment of the two. Their new technology and perceived opportunity for continued growth makes them really attractive. Due to consistent need for expansion, many growth companies are reinvesting right back into their business. In turn, they don't show a large profit, if any. Their goal is to reinvest so much into their business and increase their market share, making it really hard for any new competitor to enter that market. And since they're reinvesting so much into their business, growth stocks tend not to pay a dividend. Value stocks tend to be more mature and less about the hype. Imagine a company that's moved past that rapid growth phase, and now they're established and have more predictability. They have a general idea what their sales, their revenue, and what their expenses will be per quarter, allowing them an opportunity to pay a dividend. And while there's always volatility in the market, they tend to have less volatility compared to other growth stocks. One valuation measure used for both growth and value stocks is the price to earnings, or PE ratio. It looks at the market price of the company and compares it to the company's earnings. If a company has a market price of, let's say, $300 and their earnings is lower, like $10, the company's PE ratio will be higher at 30. This tends to be characteristics of a growth stock or a growth company. On the other hand, a company's earnings may be higher, like $30 per share, making the PE ratio lower at 10. This tends to be a feature of a more established value company. Both asset classes have had significant returns over time, but they haven't been in favor the entire time. There have been long periods where value has outperformed growth, and more recently, where growth really outperformed value. If you're curious if you should have growth or value stocks in your portfolio, click the link in the description below to schedule a free consultation with me, and I'll help you determine what's a good balance between growth and value stocks within your portfolio. Well, that wraps up this episode of The Market Interest. Be sure to like, share, and subscribe to our channel. And if you'd like a free consultation, click the link in the description below and we'll schedule a time to meet. Thanks for your time. See you guys next time.